Well, why don't we bring in the experts and find out? On the technicals, we've got Larry Shover, Chief Investment Officer at SFG Investments. And on the fundamentals, Rupal Bansali. She's the CIO and Senior Vice President at Ariel Investments. Larry, let's start with you. What do you make of these markets today? It's almost amazing that they're holding tight, given so much news we've gotten out of Europe, really negative.
It was, but I think we're just suffering from performance anxiety. I mean, that's the truth of the matter. The markets are just looking at binary issues. Yes or no to fiscal cliff, yes or no to recession. And until any of those get figured out, I think we're going to see large air pockets one way or the other. And that's what's happening right now. Most people just have their hands in their pocket and are scared to make a decision.
Yeah, understandably so. Rupal, I know that you have taken a look at a number of different sectors that have gotten hit very hard, and you're starting to find some value. I'm curious if you can walk us through what your research has produced.
Sure, Adam. I think in the US market, we saw a very big correction actually in the tech sector. And so a lot of opportunities have opened up in a sector that used to show secular growth, but currently is facing cyclical headwinds, but still offers very good secular opportunity. I would highlight names, everything from Microsoft to Broadcom to Nokia. All of these stocks are extremely undervalued. Cisco, I would throw in that mix. So any of the large cap blue chip names in tech land is pretty attractive. I'm pretty much a contrarian on Apple. I don't think this is good value here yet. I think that they're going to see some more competition in the smartphone market. So I would actually recommend that you buy old technology rather than what is perceived as new technology.
Larry, when I look at the volumes today, they're so low. Is it merely because this is Thanksgiving week and people really aren't doing anything? Or does more of it have to do with fiscal cliff and it being a pencils down environment for so many investors?
Yeah, I think it's absolutely both. I mean, right now there is, like I said, performance anxiety. People have either written off the rest of the year or are afraid to make any decision because they're worried about the fiscal cliff or worried about the recession. And really, the reality is how much of a fiscal cliff and how much of a recession if we have one. So I think your question is dead on, and I think the answer is yes to both.
And yet, Larry, as we just heard from Rupal there's some pockets of value in technology. Any of those names or perhaps some other names start to get your attention as down and out and worth a look?
Well, what I look at, I think like right now, financials and materials, I'd pick them while selling like energy and utilities. I think the momentum is for financials and materials solely based on the housing sector, which I do believe has stabilized somewhat. And the tailwind, I think we're just underestimating how big that tailwind might be.
Larry, what makes you feel so positive on financials when it's those leading the financial sector that seem most panicked about Obama 2.0?
Yeah, that's a great question. I think it just, again, it goes back to the housing sector, and I think we're just underestimating how far we've gone down, and I don't think we're going to rocket back up right away like we were pre-2007, but I do believe there's a lot of room for us to improve in the financial sector, and they will be an indirect benefit of the housing sector that's going to continue to improve in 2013.
Rupal, what's your take on housing and financials?
I think housing clearly, has room for improvement, and we're probably going to rest at these bottom levels for a while. In financials, I think the big risk to financials, which recently has caught the market's attention, and rightly so, is compressed interest margins. For a couple of years, the banks had hedged their interest rate moves, and now those hedges are rolling over, and it's showing through in the profit and loss account. And net interest margins are the revenue line. When you face pressure on the revenue line, it's very hard to grow your earnings. And that's what we saw in Japan. That's what we saw in many markets where interest rates fell hard, like in Switzerland. And I think the US has yet to experience that.
When it comes to profitability in these financials, are you concerned at all when we see big banks like a UBS simply getting out of certain businesses?
I think there was an excellent move on the part of UBS. You will see many others follow suit, or if they don't, they should. Credit Suisse will shortly follow suit. Because of the new regulations, whether it's under Basel III or under, Obama 2.0, as you said, the fixed income markets are going to become extremely capital intensive for the banks to make a market in. So you actually will see a lot of banks exiting anything related to fixed income or credit derivatives because a lot more capital needs to be put up and the returns don't justify it. For the remaining think players, though, like Barclays and Deutsche Bank and perhaps JP Morgan, that is good news because it becomes a less crowded field.
But so why is that an excellent move for UBS? UBS, year after year, was losing money in fixed income, especially in the credit areas where other banks were doing quite well. So saying that Crazy Eddie is taking itself out of business while major technological retailers are doing really well, you can't really compare the two. Should Credit Suisse go out of a business that UBS did when Credit Suisse is much stronger in that business? UBS was failing at fixed income. Why should we applaud them?
You're exactly right. UBS for many years tried to invest to win market share and to win business, but they failed. And so it's the right move for them. The reason it's the right move for Credit Suisse is that they are a Swiss bank, and the Swiss National Bank has imposed excessively high capital requirements on the two Swiss banks that makes them uncompetitive versus other banks in the rest of the world, where the UK and the US, for example, Barclays and, say, JP Morgan, don't face the same capital requirements. So it's a regulatory arbitrage that I'm referring to here that adversely affects Credit Suisse.
Well, thank you so much. Great conversation with both of you on the technicals and fundamentals. Larry Shover out in Chicago, Chief Investment Officer at SFG Investments. Happy Thanksgiving to you, Larry. And Rupal Bansali, she'll be with us throughout the hour, Chief Investment Officer and Senior VP at Ariel.
All right, so